Okay, I think we're going to try to get started. If everyone can find a seat in the back there, plenty of chairs. We have a lot of material to cover today, so we're going to get started. Thank you all for coming. Good afternoon, and welcome to the Flood Insurance Panel. My name is Annie Blatz, and I'm your 2013 MAR Secretary-Treasurer and the moderator for this panel today. As a realtor here on the Cape, changes to the National Flood Insurance Program are on the top of my mind. However, I do know that this isn't just a coastal issue. This is something that buyers and sellers, homeowners and realtors in every town across Massachusetts are going to have to deal with. I want to introduce to you our outstanding panel today. If you gentlemen would give a wave when I introduce you. Our first panelist that I'll introduce is Bob DeSaulniers, Regional Insurance Specialist from the Federal Emergency Management Agency, affectionately known as FEMA. And Bob has worked in the insurance industry in New England for many years for Fortune 500 companies in the capacities of regional underwriting manager, branch manager, and sales executive. 3 years ago, he joined the NFIP as their New England regional manager. In October of 2012, FEMA asked Bob to join them in the capacity of regional insurance specialist. He has been deployed to and served at 3 disaster offices during the Rhode Island 2010 flooding event, Irene and Sandy. Bob holds professional designations in both insurance and floodplain management and is a graduate of Boston College. Joining Bob is panelist Tom Young, manager of the National Flood Insurance Program for Region 1. As the manager of the NFIP for Region 1, Tom works with agents, lenders, realtors, communities, and government officials throughout New England. In his role, he works in a partnership with emergency management agencies throughout New England to prepare for, respond to, and recover from disasters. He also conducts and promotes outreach meetings focused on community and trade education and information. He is also a responder to nationwide events. Tom has over 20 years in the insurance industry and is a graduate of the University of Maine. Thankfully, the government shutdown didn't prevent Bob and Tom from being here today. Our next panelist is Richard Zingarelli, National Flood Insurance Program Coordinator and State Hazard Mitigation Officer for the Commonwealth of Massachusetts Department of Conservation and Recreation. Rich has been the program manager for the Flood Hazard Management Program within the Massachusetts Department of Conservation and Recreation for 21 years. He is the state coordinator for the National Flood Insurance Program and the acting State Hazard Mitigation Officer. As state NFIP coordinator, he is the primary liaison for Massachusetts communities, state agencies, businesses, and other individuals to obtain information on the NFIP and floodplain management in general. As the State Hazard Mitigation Officer, he administers the state's hazard mitigation planning and project grant programs in close coordination with the Massachusetts Emergency Management Agency. Next, we have John Gilligan from Rogers & Gray Insurance. As Vice President and Sales Manager, John oversees the personal insurance sales division of his company. A native of Cape Cod, John frequently delivers talks on the coastal insurance marketplace to real estate companies and related industry associations around Cape Cod, including flood insurance-related issues. John has over 10 years of experience in the financial and insurance industries. He's a graduate of Radford University in Virginia with a degree in finance, and he is a member of Rotary International, the Cape Cod Young Professionals, and the Cape Cod and Island Association of Realtors. And finally, we have Russell Riggs, Senior Regulatory Representative of the National Association of Realtors. For the past 16 years, Russell has advocated on behalf of realtors before Congress and federal regulatory agencies on a broad range of diverse issues, including energy, environment, national resources, insurance, and property rights. Prior to his position with NAR, Russell held positions with the U.S. Department of Energy, the National Governors Association, and the Council of State Governments. Russell has a BA from Virginia Commonwealth University and master's degrees from Tufts and New York University, and he resides in Falls Church, Virginia with his family. So please join me in welcoming our panelists today. Now I'm going to explain how our panel is going to work this morning or this afternoon. Each of our panelists will give a brief presentation, and then I have some questions for the panel to discuss, and then we'll open the panel up for questions from the audience. Each of you should have received an index card when you entered the room. If you have a question for the panel, please write it on the index card and hold the card up anytime during the discussion, and the MAR staff will be collecting those cards, and they will hand them to me to read when we get to the Q&A portion of the session. So now that we know how it's going to work, let's get started. And the first person I'll ask to come to the podium, I think, is Russell Riggs from NAR.
Thank you, Annie. Appreciate that introduction, and thank you to the Massachusetts Association of Realtors for the very kind invitation. Greetings from Washington, D.C., or as I like to say, 4 square miles surrounded by reality. And it's particularly apropos, I think, today that, given the shutdown and the situation, that I think they need a large dose of reality in Congress right now, in the entire city. But we're here to talk about another reality, the changes to the National Flood Insurance Program. So I'm here on the panel to set the stage, if you will, provide a broad overview, a 30,000-foot view, if you will, of what's happening with the National Flood Insurance Program. And then the other very capable panelists will provide more specific details. But in the presentations that have been giving on the National Flood Insurance Program, and I've been doing this for, well, for as long as I've been at NAR, flood insurance has been an issue, but certainly the past 6 months, interest in it has certainly picked up. And I like to describe it as the past, the present, and the future with the National Flood Insurance Program. Where were we in the past? That led up to what happened in the present, the very near present, and then where do we see ourselves going in the future on this, on the National Flood Insurance Program? So let's revisit about 10 years ago, 8 years ago. Let's talk about the past a little bit. What was going on with the National Flood Insurance Program that was causing issues and concerns across the country? Well, remember, if you remember, the flood insurance program was not in great shape. Back in 2005, 2004, it was really surviving on short-term extensions. So the Congress, it would come up for reauthorization, and you have to have it reauthorized every 4 or 5 years. So it would come up to a reauthorization. Congress would reauthorize it for 3 months, for 6 months, for 2 months. 18 of those short-term reauthorizations between 2008 and 2012. What does that do? That causes uncertainty in real estate markets. And don't forget, you also had 2 lapses of the National Flood Insurance Program. And now when the program lapsed, there was no National Flood Insurance Program. There was nothing. So you were unable, if you had a client that was needed to purchase flood insurance, you couldn't do it during that lapse period. There were 2 of those. We estimated there were about 1,300 closings that were delayed and canceled per day. Because remember, this is a national program. So 1,300 every day the program was not in existence. There were 2 of those. What does that happen to real estate certainty and credibility across the country? It completely undermines confidence in real estate markets across the country. So you had lapses and you had short-term extensions, caused big problems. You had bad maps. I would get calls all the time from members who said, wow, this map, I don't understand it, I can't read it, it's on a piece of paper that is very confusing to me. I can't get the map because I have to call the map center and they have to actually mail me the map. I mean, it was ridiculous. And when you got the paper map in your hands, lots of times it was incorrect or it was inaccurate. It hadn't been updated for 15 and 20 years. So the maps were bad, very bad. And remember, when you have a bad map and you're trying to inform your client about whether or not they're in the floodplain and you are incorrectly, or the map is incorrect, that puts you in a negative liability situation. Then to add insult to injury, you had Katrina. $17 billion in debt as a result of Hurricane Katrina. Now people were asking me, wow, $17 billion, what did FEMA do with all that money? Well, that's not exactly what happened. $17 billion in debt was people putting claims on the National Flood Insurance Program. They paid their premiums and they got flooded, and so they wanted to make a claim on the program, which is absolutely what they should be doing. But Katrina was such an outlier storm, that's why you had $17 billion in debt, because there's no way FEMA was ever prepared, the National Flood Insurance Program could have covered that many people now putting claims on the program. That's why they had to go to Congress to say, we need more money. We hadn't collected enough premiums for this. We need additional funds to make sure we can pay all the claims, and that's why you had a debt situation. An additional insult to injury was Hurricane Sandy. Again, the exact same situation. Huge outlier storm. The National Flood Insurance Program, or no insurance program, can cover the size of these storms. And as a result of Sandy, as a result of everyone who paid into the program now making a claim on the program, again, you have an additional $10 billion. So there's this huge debt overhang over the National Flood Insurance Program of $28 billion, $25 billion, something like that. So as a result of these short-term extensions, problems with the debt, the bad maps, there are people in Congress who would love nothing more but to get rid of the National Flood Insurance Program. Would love to just see it go away. They get tired of having the federal government be involved in an insurance program. So all that kind of came to a head in 2011 and 2012. And that's when the Biggert-Waters legislation, which was, by the way, was really only one iteration. I mean, there had been several different bills in Congress to try to deal with some of the inherent contradiction of the National Flood Insurance Program, try to reform it, get it on a more actuarial, a better financial situation. Because remember, if there is no National Flood Insurance Program, where do you go to get flood insurance? Other than Lloyd's of London or Chubb or AIG, there is no private market for flood insurance. That's why the program was started in the first place back in the late 60s. There is no private market for flood insurance. So it's either this or it's Lloyd's of London. And clearly the program needed reforms. And that's what Biggert-Waters legislation of 2012, co-sponsored by Judy Biggert, representative from Illinois, and Maxine Waters, representative from California. NAR supported that legislation. We felt, given what had been happening with Katrina and Sandy, the short-term extensions, our members made it, and the lapses, our members, you, made it very clear to me as NAR staff, you have to not have that happen anymore. We have to have certainty in real estate markets. We need to get this program on a longer term situation. But in Washington, D.C., you don't get anything for free. You have to give something to get something. It was the best deal in a bad situation that we could have. We got a long-term extension through 2017. We had to give up subsidized properties and some other reforms that had made flood insurance less expensive and made it affordable. So what's happening right now in the present? Well, as you know, the full implications of this bill are starting to be known. Rates are going up. There's no question about that. In some cases, many cases, unsustainably. And we're seeing the effects in real estate markets now. Buyers are walking away from deals, from transactions that everyone thought was a good deal, and all of a sudden they learn that there's a flood insurance situation. And the flood insurance is too expensive, they can't afford it. People may be pushed into foreclosure. That is a very real possibility if they can't afford the new flood insurance premium rates. New and more accurate maps are coming online, triggering other rate increases in the future. Now, NAR has been very clear for the past decade, we need accurate flood insurance maps based on the best science, the best technology, and more importantly, data collected at the local level. Because the folks at the local level know what the risk is, and they have great information and data, and they can feed that into the new mapping as the new maps are coming online. But we absolutely have to have the maps. We have to have new maps. We have to have the best maps. Some of these maps, as I'd said before, are 15 and 20 years old. These floodplains change over time. They shift over time. They don't remain static. And that's why the new maps are there to make sure that when the floodplain changes, we understand the changes and who is now mapped in and who's now mapped out. What's happening right now in the present? Maxine Waters has said she never intended these kinds of unsustainable flood insurance premium increases. So I think there's lots of, there are many pieces of legislation right now in Congress to address that. What we are supporting right now, what NAR is supporting, is a delay of both and they're going to get into the details of this, but NAR is supporting a delay of the grandfathered properties plus a delay of the new purchase provision. Because we think right now Congress needs to step back, or FEMA needs to step back, do an affordability study, which was mandated in the Bigger Waters legislation, do the affordability study to really assess the implications and impacts of these high insurance premium rates on the affordability of real estate. Is this really going to force people out of their homes? What's the full extent of how high these rate increases are going to go? And then once they have that affordability information, once they've collected the data and reported on this and understand the full ramifications, then at that point they can go forward with moving ahead with these premium increases. But you have to understand what's going on first before you can go forward with it, and really truly understand the impacts on real estate and on property owners. So right now there are a couple of different bills that would do that, and we are supporting the movement of that. We also think there needs to be a longer glide path in terms of how these subsidized properties are getting phased out, as well as the purchase provision. We think that there should have been a glide path, and we work to try to get that in terms of a 5 or 10 year phased-in period so that new owners can have a chance to adjust to these higher flood insurance premium rates. So what's going to happen in the future? Well, I'll try to get out my crystal ball, and let's talk about a little bit about what we think might be happening in the future. Well, we're going to continue to support legislative activity in this area because we think at this point we've urged FEMA to look at the bill, try to find flexibility and discretion where they can in the legislation that would allow them to delay or at least slow down some of these premium increases. Administrator Craig Fugate, FEMA administrator, was at a hearing about 2 weeks ago, a hearing in the Senate, and he said, I have looked, my lawyers have looked, everyone has looked at FEMA. They cannot find discretion and flexibility in how to implement these rates. The law is pretty clear. Now, it's NAR's contention that they do have some discretion, and we would love for them to look at the words in the legislation and try to expand their understanding of what these words say, because you need to slow down implementation of this legislation. We're educating realtors, and this is just one, me being up here this afternoon, it's just one way that we are doing that. We have a very robust web page and toolkit on realtor.org with lots of information about this issue, the details. We have disclosure language that was developed by NAR Legal Affairs to help you write some language as you're disclosing the fact that the property may be in a floodplain. I believe that was handed out this afternoon. So we're educating. We're doing what we can to work with Congress and with FEMA so that they truly understand the impacts that this legislation is having on realtors and their clients in real estate. But there still remains a challenge that we need to address. And I need help addressing this from you, because I'm having a tough time reconciling how we move forward. There is no private market for flood insurance. You cannot go and buy flood insurance like you can buy homeowners insurance or car insurance. It doesn't exist, except in very limited cases. So my challenge, and the challenge for everyone here to think about, is how do we keep the program, because now this is the only thing left. If you can't buy private flood insurance, the only other option is through the National Flood Insurance Program. So how do we keep the program sustainable and viable over the long term while making sure flood insurance is also available and affordable? And it has to be actuarially responsible. You know, sometimes this is like these two different things are in direct contradiction with each other. Affordable and available. Sometimes that works, sometimes it doesn't. Solvent and viable over the long term, even though we know we have a $25 billion debt hanging over the head of the program. So help me understand how I can move forward in Washington and communicate our message to legislators and to the FEMA officials about how we work through making the program solvent while still having made available and affordable flood insurance across the country. So that's really my, my message, if you will, and my question. And would love to, looking forward to the Q&A and to the discussion after the other panelists have spoken. So with that, thank you.
Thank you, Russell. Next we'll have Bob DeSaulniers and Tom Young from FEMA. Gentlemen.
Bob's acting as backup today. Thank you very much for having us. This is a tough topic for the public, for community officials, and for people that have to deal with the public that is trying to deal with flood insurance. As Russell has highlighted, this is an issue that's been out there for several years. Back in 1968, Congress was approached, and basically they were told that we have a crisis. And they recognized it from the flood mitigation, disaster recovery that was going on. And they said, hey, we can't afford this from a tax standpoint because we can't set budgets. So why don't we get the insurance industry to get in this program? How can we get them in? And Congress came up with this great idea. We'll form the National Flood Insurance Program. And over time, the rates will stabilize, and we'll be able to show where the floodplains are, and the insurance companies will be able to step in and write flood insurance. Well, what didn't happen was that that philosophy didn't carry forward. And over time, some of the rates stayed really low. So low that, well, so low that Congress couldn't budget for floods. That's what happened with Katrina and a few other events. So they couldn't charge adequate premium, so they had to pay out something like $20 to $30 billion, which is basically where we're at right now with the flood program, where we're paying in the rates the interest on that billions of dollars. So one of the things that many people get confused on is FEMA. Why is FEMA doing this to us? Well, FEMA is a very important organization within our country. The Flood Emergency Management Act is the group that responds. They're the ones that come out. They're the ones that try to identify where the hazard zones are so that we as consumers and the public understand what's happening. And that's what FEMA does with the flood program. They delineate where the flood maps are. They don't go out and trace around people's homes. They're looking at the topography and what the wave action is, and they're building maps that are pretty darn precise in where the water will flow. How many of you own property in a floodplain? How many of those people have flood insurance? So there's a small group here, and even a smaller group that have flood insurance. And that means that the rest of the people in the flood zone don't have flood insurance, so they're assuming that risk, which was what was occurring most of the time before 1968. Most of the people assumed that risk. Well, when you take into consideration that 5.5 million flood insurance policies are out there, and maybe 30, let's say 50% of the audience that has flood insurance raise their hands, that kind of gives an indication that possibly there's 10 to 15 million people out there that should have flood insurance if they were going to be in a flood zone, or they're probably already in a flood zone. So there's a large group of people out there exposed, but there's an awful lot with flood insurance. Now, FEMA is doing the mapping. They're trying to protect and respond. Where does the National Flood Insurance Program come in? Well, Congress created the National Flood Insurance Program before FEMA. And they said the best place for the National Flood Insurance Program is within FEMA or underneath FEMA, which makes sense. But it's not the insurance companies that are forcing people to buy flood insurance. The National Flood Insurance Program is a method of protecting the public access, our assets, a method of responding, resilience is what they call it, to a disaster. Because if you had to wait for the taxpayers to come forward with the disaster assistance, it could be a long wait. I think disaster assistance is under $30,000 at this point, and even then, that is nowhere near enough to rebuild homes or put homes back on their foundations. So we have FEMA, we have the NFIP, and there's one other group out there that is so instrumental to you, and that is the lenders. So the reason I'm going over NFIP and FEMA is how they fit into this picture. Now, Congress required lenders that if you're going to use federal money for anything and you're going to have assets used as collateral, then those assets must be protected from risk, whether it's fire risk, whether it's earthquake risk, or whether it's flood risk. After a few national events, national flood events, it became apparent that the banks weren't requiring flood insurance. And that meant that the lending institutions or the government had to take it on the chin. So what they did is they said, okay, under Big at Waters, we're going to change this a little bit. So under Big at Waters, penalties for banks that failed went up to $2,500 per loan. Now, when you start talking about to a banker about penalties, and they see $2,500 per loan, they know they can't build that into the loan. So they're being very aggressive in enforcing the requirement that if you're in a floodplain, you're going to need to take out a flood insurance policy. So I just wanted to give you an overview of the steps in the process and who the players are, because we're really all players in this. I had the pleasure of being with a Fortune 500 company for 12 years. I was in risk management, but I also had the pleasure of managing over 8 million square feet of real estate with total asset value of $3.3 billion. And when I went out and negotiated for real estate or even leases, one of the things I was trying to make sure is that even the parking lot wasn't in the floodplain. Because if you can't park the cars, you can't get the people in, then it's going to interrupt our business, and we just couldn't afford that. So I forgot to ask, is Bob's time included with mine? All right. Well, I want to make sure that he gets adequate time because I report to Bob. You know.
Doing all the bad stuff for me.
Well, I want to make sure you understand a couple of little items. One is you're going to often hear the term pre-firm and post-firm. Now, firm stands for flood insurance rate map. All right, flood insurance rate map is how the underwriters rate the policies. Pre means before the flood insurance rate maps, and post means after the flood insurance rate maps. Why is that important? Because after the flood insurance rate maps were put in place, the DCR stepped in and said, hey, we're going to make sure the communities are building into compliance with floodplain management. And Rich can come back and straighten me out after, when he gets up here. But that was the concept. Post-firm structures are built into compliance with the flood maps at that time. Pre-firm aren't. Pre-firm were built prior to the flood maps, and unless there's substantial improvement, they're not going to change unless the owners want to change them. So what Congress did is to make sure that they originally got into the program, they offered subsidies. They subsidized the earlier policies to get them into the program because they're really the ones that needed to be in the program. But what's happened over time is those subsidies haven't been taken away, and as premiums increase, the subsidies, the disparity between properties that are post-firm and pre-firm occurred. 3 weeks ago, I got an email from a lady, don't even know who she is, and all she asked is, can you help me? And she sent an attachment. I opened the attachment, and the first page was her deck policy, her tech page of her insurance policy. And I saw premium, $8,500. I saw she had a post-firm home. She had full limits that's available under the NFIP of $250,000. Her post-firm home was elevated well above the floodplain. But she was in a VE zone, one of the wave velocity zones. So it's a higher risk zone. So I went to the second page. What did the second page have? It had her neighbor's house sitting on the sand, not elevated, not in compliance with the floodplain ordinances now, but when it was built. And they were paying $3,800. So you can see the disparity. $3,800 pre-firm, $8,500 post-firm. So pre-firm is where Bigot Waters is addressing. They're looking at those properties that are receiving subsidized rates. And that's what's coming into play. With 5.5 million policies out there, we're probably talking about around 35,000 policies in the state of Massachusetts that are pre-firm, and will, of that 35, probably around 40%, because we in New England are blessed to have an older stock of homes. And when our homes were first built, they were built along rivers and streams because we needed the water, and we lived on the rivers. So those homes are still here. So we have the pleasure of having probably the largest stock of pre-firm homes in the nation, which is affected more than other areas. Because I can look at Florida, and I can look at Louisiana and Texas, where they have 60% of all flood policies, and they probably only have 9% of pre-firm homes. And you say, why is that? Well, you take a look at the number of hurricanes they've gone through, and how many of those homes have been washed away and then rebuilt. And when they were rebuilt, they had to be rebuilt the right way. So I've given you an idea of the history, and I've talked to you about pre-firm and post-firm. Bob's probably not going to talk about grandfathering. But I think I'm going to leave it there because I know Bob has quite a list, and he's got all the good stuff on Bigot Waters. So my attempt was to the introduction of this. So, Bob?
I think I've been in the program now for almost 4 years, and I had Tom's job before I came to FEMA. And one thing that I have done a lot of is talk with property owners, hundreds of them, thousands of them. I understand the hardships that the flood program brings to them. I've also seen some of them that have been able to take advantage of having a flood insurance policy and be able to rebuild their homes, etc. But when it came to what Tom had referred to as, you know, the program had to be reformed because we were losing money, etc. Living in New England my whole life, the people I talk with, most of them had older homes. And I have talked one-on-one, I've talked in large groups. Some aspects of this particular reform bill can be devastating to people. So one of our challenges has been not to come out and be apologetic, even though I have a nice Jesuit education to be apologetic about things. But it was more important to come out and tell people what had happened, what had changed, because there are people out there that have the older homes, 40-something% in New England. A lot of them are like me, they're baby boomers, maybe they've paid their mortgage off. They don't really give much thought to flood insurance or where it fits in. So at any rate, one of the things I'm going to do, and I'll pick up the pace a little bit, is just go over exactly what's changing in 2013 and then going forward. Tom set the same, and one thing too I'll mention is that before Bigot Waters, we used to have these type outreach meetings when the maps changed, the flood insurance maps changed. So what's happened now is we got map changes which bring certain challenges, and then we have the Bigot Water Reform Act, which is bringing certain challenges. And in New England, they're like two trains going down the track side by side. And a lot of people, just kind of lump it into one problem, so to speak. But in fact, the mapping is something that started a long time ago. However, when you get to the Bigot Waters, you're going to see where some of the mapping changes will trigger some of the more difficult pieces of Bigot Waters. But at any rate, we mentioned pre-firm homes, the older homes. Just think of it in terms of older homes that, out of fairness, back in the 60s, when they put the program in place, these buildings did not have the guidance of flood maps or building ordinances. So the program cut them slack in two ways. Maybe the most important is that they do not have to be rated using the elevation of their lowest floor. That's a big one. I mean, when we develop flood insurance rates, where your lowest floor is in relationship to that 1% flood line that will come in and where the water will surge to, that's a big factor in how high the premiums can go or how low they go, depending on where your lowest floor is in relationship to the 1% flood surge line. The second piece is it was an outright discount. So in other words, we have a group of policies for which we're collecting premium and paying out losses. At the beginning of the program, my understanding was they built in a 40% discount. So besides not having to be rated using elevation, they also had a discount built in. Now, the people I know that were involved in the program back then, there was, just like Tom had mentioned in Florida, there was a sense that these older buildings wouldn't be here now. Okay, but anybody who lives in New England knows that, you know, the older buildings are oftentimes built a lot better than the new ones. But so at any rate, these older buildings did not have to be rated using elevation, and there was an outright 40% discount. Over the years, they've brought that discount down somewhere probably in the vicinity of 30%. So that's a subsidized premium. That's a lot of the people that have flood insurance policies in New England that have the older homes. They were never asked to get an elevation certificate. That's where you have a land surveyor come in to measure where that lowest floor is in relationship to 1% flood. And they've been able to benefit from generally lower premiums than what should have been charged for the experience of that large book of business. Okay. The other type of subsidized premiums where somebody pays less than they should, Tom had mentioned, was grandfathering. It's kind of a same fairness type concept. The way the program looks at it, that if when you bought your policy, you were in a particular flood zone, or the maps reflected a certain elevation that you had to meet or exceed, if you did that and then you continued coverage, even though we would come in with additional map changes, so long as you didn't let that policy lapse, we would continue to rate it with the flood zone and the elevation that was in effect when you bought the policy. So that's called continuous coverage or loyal customer grandfathering. Then the other type of grandfathering, and again, it's kind of a fairness concept, if you built your house, so the flood maps are already in place, the ordinances are already in place, and when that building was built, you know, you met or exceeded the building ordinances, you did everything in compliance. Later on, whether there's a policy in effect or not, whether it's the owner who built it, whether it's the 3 owners down the road, there is a built-in compliance grandfathering rule that basically says that if you can present to the insurance underwriter a letter from the community official that confirms that that building was built in compliance and that it hasn't been subject to substantial improvement along the way or anything else that would impact where that lowest floor was, then we would rate the policy based on the flood zone and the elevation that was on the map that was in effect when it was built or when it was permitted. So those are a lot of people in New England, even though we have most of the older homes, and that's the bigger issue right now, a lot of people do benefit from these grandfathering rules. Where it stands as far as the grandfathering is that that particular subsidy will not begin to be phased out until the end of 2014. That's when FEMA has to provide Congress with an implementation plan, and it'll be phased out. In theory, it'll be initiated by map changes that have happened since the Bigot Waters was signed. So in New England, you know, all of our coastal maps probably fall in that category. But what will happen is once they come up with an implementation plan, then over a period of 5 years, people would see that their premium would go from the rating characteristics that were in effect when they had the policy, or initially bought it, or when the building was built, to reflect what the premium should be based on the current map, the current zone, the current, what we call the base flood elevation. So that now we'll shift back to the older homes because in 2013 is when the implementation plan for the older homes, when we had to start that. So going back to January 1st of 2013, the first piece of the older home phase out of that discount we referenced. We're not asking the existing policyholders to stop and get an elevation certificate and be rated using elevation, but we are starting to phase out that portion of the premium or phase it back in, whichever way you'd want to, best understand it. Congress identified in the law that certain buildings they felt should get that discounted premium phased back in faster than others. So a very small percentage of our total book of business is impacted by what we call the 25% phase-in. January 1st of 2013, if you had a non-primary residence, a seasonal residence, one that was not primary, so that might include rental property, you'll see your renewal will start to have up to a 25% increase over the next 4 years. The next big move was renewals effective October 1st of this year, just last week. So any renewals that come out effective after October 1st of 2013, if it's a severe repetitive loss property, and the people that have those policies know who they are because they have gotten a letter from FEMA saying that the number of losses and the severity of losses that we've paid out, you are in a severe repetitive loss category and have to be underwritten directly by the National Flood Insurance Program. They didn't get a rate increase. They basically are just identified, and community officials are made aware of which addresses those are because they should consider them in their mitigation plans. And mitigation just means in whatever way they assist buildings to get them out of harm's way. Then the next type of building that Congress felt should be fast-tracked in loading back in the discounted premium were commercial buildings. And the thought process there was that, at least they're able to pass along costs. We only identify buildings in our program as being residential and non-residential. So over the years, with the new applications that they have out there, they'll start to identify buildings that are non-residential that maybe are not commercial, and there's a possibility that that will be considered in in the future to give them if it's a non-profit or a community building, that sort of thing, that they might get some break on the how quickly the discounted premium gets fed back in. Last but not least, and it kind of leads into maybe a really serious situation from my purview. If you let your older home policy lapse, okay, the way the flood program works is that you have up to 30 days after the expiration of the policy to pay your premium. So even if you have a loss during that 30-day period, I believe as long as your premium payment is recorded on the 29th day after the expiration date, that they'll backdate the coverage and you'll be whole. There'll be no gap in coverage. If you pay the premium after that grace period, then there is a gap in coverage. They'll still give you a policy, etc. But what's going to happen now with Bigot Waters is that would have to be considered new business, and any new business since the Bigot Waters Act was signed, whether it's an older building or not, they want it to be rated using elevation. So that person would be given a tentative rated policy, but told that, within a reasonable time, you need to provide us with an elevation certificate, and we will rate it using elevation. Then, leading from lapsed policies, anybody that owns an older home, a pre-firm home, that does not have a flood policy currently, and may need one going forward. When would that be? That would be if they refinance, do a reverse mortgage, could be a line of credit, could be that they want to sell the house and the person who's going to buy it will be taking out a mortgage and will need flood insurance. So going forward on the older homes, if they don't have a policy right now, then they're going to have to be rated using elevation. So if it's a house that has a basement along the coast or along rivers, and that, again, the way that we rate policies, the lower your lower floor is in relationship to that 1% flood line, the premiums get extremely high. Similarly, when it's above, the premiums get extremely low. Some of the folks that were rebuilding after Sandy and Irene went from paying as pre-firm risk $3,000 a year, and after they elevated just 1 foot above that 1% line, their premiums went down to $800 a year. But at any rate, that's the biggest thing that you need to know, that the older home changes have already started, and that if you have clients or friends or family that like my friends, that because they paid their mortgage off, they don't really aren't concerned about flood insurance. They need to know what zone are they in right now. Maps are changing. They need to find out what zone they might be in when the maps take effect. Last but not least, there was just Congress, part of the Big at Waters, said that the program has to create its own 2% reserve fund. So have a reserve fund equal to 2% of the premium written out there. So starting with October 1st, all the policies are getting a 5% increase to just start building up that 2% reserve fund. One other thing that you need to know is that there used to be a 10% cap on how much we could charge on any given renewal. Big at Waters has moved that up to a maximum of 20%, with the exception of the 25% situations that were outlined in the law. The sole purpose of them moving that 10% up to 20% was so that each year FEMA would be able to move back in more of the subsidized premium. So that October 1st is the first time that people are going to see double-digit increases if they're rated without elevation, if they're older homes. The people that are already rated using elevation, will see a 5% to start the reserve fund, but generally won't see, the kind of increases, because there is no subsidizing there that's got to be moved back in. Just quickly, some other things the program did. Affordability, as mentioned earlier, that they have commissioned an affordability study. It's something that Congress has told FEMA has a top priority, but as you mentioned, it's probably not going to be available anytime soon. They also asked that the premiums that FEMA come up with a premium installment plan, because our premiums have to be paid up front. So we're still working on that. There is nothing in place yet for that. Grandfather rules, again, aren't impacted right now. So if somebody has a policy today that is benefiting from one of the grandfathering rules, they can still assign that policy to the buyer. So we tell insurance agents that it can get very confusing, but they should definitely, not discourage people from trying to get the flood policy of the person who's selling. Okay. And other than that, just want to leave some time for questions. I could go on, unfortunately, for a little bit longer. There's so much detail to this. But one thing I just want to, and this will be the end of it, being in insurance for so long, and I've done professional liability insurance, underwriting, etc. With all the people I've talked with over the last 4 years, and this is advice that I give to community officials, to anybody. We had a case, for instance, when the city of Memphis, Tennessee, got severely flooded there a couple of years ago. It was so clear to the authorities, based on what people were saying, that insurance agents told people not to buy flood insurance, or told them they couldn't buy flood insurance, that they started 2 separate class action suits, big front page, etc. Ironically, neither of the suits went anywhere, because insurance agents showed that they were offering to have flood insurance as part of the person's portfolio every time they sent out a homeowner's renewal. Generally, it was you know, they were covered. They had procedures where it showed that they always, you know, offered the coverage. But it brought the point is that no matter what you say, what I've found over the last 4 years is people only hear two things, okay? They either hear, I'm not in a floodplain, or they hear, I don't need flood insurance. And so if you bear that in mind, so as the words start to come out of your mouth, and if it sounds like those two phrases, you know, pull it right back. The best thing to do is just tell people that you're not an insurance expert, that you advise everybody to have insurance if it's at all possible, including flood insurance. If you do that consistently, you know, then when there is a flooding event and they don't have a policy, you know, at least you'll be able to defend yourself because, you know, people, it's not like everybody is, you know, out there just telling lies or trying to make money in a class action suit. They're so devastated that they didn't have a policy and they had so much of a loss that they just assume that somebody told them not to get flood insurance. So that's it.
Thank you, Bob. And next we'll hear from John Gilligan from Rogers & Gray.
Good afternoon. Now that you've heard a lot of the good news about all the rule changes and whatnot, I really wanted to come and help you understand some of the things that are really happening in the community today, some of the changes, how they've impacted people, kind of giving you an overview of what we're dealing with as an insurance agent on that side of it. Obviously, there is a huge number of changes that have taken place. Right now in Barnstable County, we're dealing with the effects of both the Bigger Waters bill and then the preliminary maps which have come out in the communities and now are also causing the change, as Bob said. It's all happening simultaneously for the New England area. So that's one of the biggest things that we're facing up against because we really become the front line with both the community and homeowners here as well as realtors and anyone else that's trying to interpret what's happening because of all these changes. So some of the big ones that have come up have been obviously the buying and selling of homes in special flood hazard areas, specifically with the changing of rules and the different policy types that are out there, because you could have someone that's on a pre-firm policy now that Bigger Waters is in place, it's not going to be eligible for a pre-firm policy. They're going to have to go through the process of getting an elevation certificate. Rates are going to be different than what they're paying, and no one really knows which policy is going to really override the other. There could be other instances where you've got someone in a post-firm structure where that policy is transferred. A homeowner already has an elevation certificate. We submit that, and the rate stays the same. There's no change, and at the end of the day, you know, the full risk was understood prior to that home being purchased. So certainly the special flood hazard areas with the new rules in effect are becoming questionable on both ends from current property owners, buyers, and certainly realtors as well. In addition to that, one of the changes in Bigger Waters was the second homes getting that rate increase, and due to the nature of the area that we have here, we have a lot of people that buy what they plan to be their retirement home. When they originally bought it, they set their flood policy up as a secondary home, and now they are all getting a renewal with a 25% rate increase. The thing is, that home has now become their primary home. So there are channels to go through to get that corrected, and certainly it's something that we do address with our specific clients to help them through that process. File the correct changes to their policy to make sure that they get a less of an increase, and that's, you know, going to go back to still on a pre-firm policy, but it ends up being, you know, it could end up being about half the increase or a little bit more than that. So that's certainly one of the important ones that has been coming down the line over the past couple of months here. Elevation certificates are going to become critically important for people in flood hazard areas. So many of the homes that are in our area, as kind of been the recurring theme, are older homes, and so the pre-firm policies were an easy way for us to get through that hump of flood insurance for many of the purchases in this area. now with the new rules in effect, elevation certificates are really the only way you can determine what that risk is going to be, how much that policy is going to cost in the long run, and really assess that risk in general. So, you know, we can always help someone by getting a tentative rate policy in a special flood hazard area. It does get someone through a closing, and it can get, you know, things done very quickly. So that is, you know, a way through it, but at the end of the day, it really doesn't help that buyer assess the risk that's in front of them. So that's something that the elevation certificates are always important for people to consider. And then in addition to that, the changes that are coming down the line with the new maps, and we are getting inundated with calls basically asking what's going to happen, what applies to my situation with the new maps coming into play for both pre-firm, post-firm structures. How do we work through this? So that's as those maps come into force, you know, people need to understand that they can get preferred rate risk policies now ahead of that map. They can extend that policy to help alleviate some of the rate increase they'll see from that special flood hazard area. So looking forward to continue to disseminate information to the community, and let's move right along here because I know a lot of people have questions and answers that they want to discuss.
Thank you, John. And our final speaker for this portion is Richard Zingarelli from the Commonwealth of Massachusetts, Department of Conservation and Recreation.
Thank you. I have the sort of enviable position of trying to go through quickly, picking up little things that weren't picked up along the way, and still leave us plenty of time for questions. So I'm going to do my best on that. I've been asked to talk a little bit about the map changes. One of the things that Russell mentioned that I think is very important is the fact that most of the data on the current maps is indeed 20 years old or older. And so the maps that we've been dealing with all of this time have been somewhat inaccurate. They're difficult to read. The new maps, I'm not going to tell you the new maps are perfect. They're certainly not perfect, but I think overall they're much better than the maps that we've had in place in the past. FEMA has basically been in the process of updating the maps throughout the country. And one of the things a few years ago was they were directed to update the maps to a digital format with new engineering studies for all of the populated coastline. And as Bob was saying, what's been happening with the map changes in Biggert Waters has sort of been lumped together in people's minds, and they're really two separate processes. And those map changes were actually underway well before Biggert Waters was passed. The changes that you see in the floodplains come from better understanding that we have of how flooding occurs and where flooding is likely to occur. And I want to talk about some of the things that I've been hearing people say about the map changes that are kind of misconceptions. The map changes are not being done specifically to recoup the deficit in the National Flood Insurance Program. A lot of people think that's why FEMA has been doing this. If we expand the floodplain, we can get lots of new policies and recoup the deficit. That's certainly not part of the plan. A lot of people think that these map changes were in response to, specifically in response to Katrina, Sandy, and Irene. And again, these changes were in the works, certainly before Sandy, even to some degree before Katrina, or they're not at least directly related to Katrina. And the other thing I think that's important for people to recognize, because I've heard a lot of people saying this, these changes have pretty much nothing to do with projected climate change. Okay, the maps reflect what the risk is expected to be currently, not taking into account any future climate change. They've taken into account whatever may have occurred in terms of sea level rise up until now, but not any changes that are expected to occur in the future. The last thing is that these new maps have been issued as preliminary maps predominantly. They're in now what's called a formal appeal period, which in most of the counties in Massachusetts where we have new maps are ending within the next week or two. After that formal appeal period is ended and FEMA has resolved any appeals that may occur is when these new maps will become effective. So these maps will not go into effect until next summer at the earliest. So what that means is nobody's premiums, current premiums or current renewals should be in any way affected by the new maps. Certainly transactions that may be occurring in the future or planning for how you're going to deal with your property in the future needs to look at the new maps, needs to look at what might be changing in terms of the premiums, both in terms of what the new maps are doing and in terms of Bigger Waters. But I've read a lot of stories of people saying these new maps are making my premiums go up to $20,000, $30,000, $50,000 a year. And I would say in almost all cases, that is in error. There's a lot of uncertainty out there. Russell used the term uncertainty about the sort of history of the NFIP. I think there's a lot of uncertainty right now in terms of the map changes, in terms of Bigger Waters, and what the effects are going to be in the near term, say the next year or two, versus what the effects are going to be in the long term. And I'll tell you that with rare exceptions, people, as Bob mentioned, where the policy is lapsed, where they're getting new policies, without those, except for those certain cases, most people's changes will be, I'll say, relatively minor. There'll be the 25% annual increases in premiums that Bob was talking about in certain classes. In terms of map changes, since grandfathering is still in place, and since anybody that's mapped into a flood zone is eligible for the preferred risk policy extension, by and large, nobody should be looking at immediate large premiums as a result of a map change. Down the road, as grandfathering is implemented, absolutely. I'm not trying to minimize the effects of these changes. But these are changes that will be phased in over a number of years under current policy. And as Congress looks at whether they are going to amend Bigger Waters, they could actually move that phasing in of these new rates even further. But that's up for Congress to decide. One of the other things I wanted to make a point on is that a lot of people have been talking about how FEMA's creating these rate increases. That's partially true, but have to keep in mind these are in direct response to a law passed by Congress that directed FEMA to make these changes, to make the NFIP more self-sufficient because of the amount of money that the NFIP owes the Treasury and essentially owes Congress right now. And as sort of a summing up, and I think, Russell, you certainly started on this. I think this is the key part of this whole thing, is you have two concepts that are battling each other, and they have to somehow be reconciled. One is, how do you make the NFIP sustaining and self-sufficient? And the other is, how do you make flood insurance available widely and affordable to people? And those are in direct conflict. If you go immediately to actuarial rates, or even over a period of several years, there will be a large number of people that will not be able to afford the insurance. I get the calls regularly from them. People that are on fixed incomes, people that are retired and can't afford large insurance premiums because their home is their only asset. But by the same token, the program can't keep going the way that it has been with those subsidies. You know, it's 20, 30 billion, I don't know what the exact number is in debt right now. And as it's currently structured, that would only increase. So that's kind of the short-term future. And I think the bigger thing is what is going to be the long-term future. And ultimately, it's really only Congress that's going to be able to make that decision and make those changes. So that's really the message. Congress has to look at this and figure out how they're going to make this program sustaining for the future, or there are other alternative, as was mentioned, to eliminate the program and put everybody on the private market where, trust me, the pain and the uncertainty in the real estate market will be much worse than it is under the current program. So thank you very much. I appreciate the chance to talk to you. I look forward to the questions.
Thank you. Well, those were all rather thought-provoking comments from everybody, and in collecting the questions that you're asking, there's some amazingly intuitive questions here, and we'll see if we can get some answers. Starting with the first question, which kind of is based on what we were just most recently heard, is there anything we can do on a regulatory level to reduce the increase in flood insurance rates, or can that only be changed by Congress? Anybody want to take that?
Well, I think one thing is being realistic, we do find that there are some insurance policies that maybe have errors in them. So we would encourage the insurance agents in particular, not so much the real estate agents, but when people get, very high premiums to ask the underwriter to review the rating of that policy. They will, but sometimes the insurance agents, they don't have a personal relationship with that particular underwriter, so they'll ask a question like, is that premium correct? And of course they're going to say, yeah, oh yeah, that's correct. But if they specifically say, this is an extraordinary premium for my client, can you have somebody review what you have? Maybe there's data that we can give you that he's had the policy for 20 years and there's just missing information that could help that out. We see it every day.
Russell?
Yeah, one thing I wanted to mention, FEMA has a program, FEMA has lots of programs related to lowering premiums in communities through elevation grants, mitigation grants, as well as a program called the Community Rating Service, the CRS. Now, this is a program sponsored by FEMA that if a community participates, it can lower insurance premiums for the residents of that community up to 45%. Now, this is something that 22,000 communities are in the National Flood Insurance Program. Only about 2,000 participate in the CRS program. So this is something that we see as a great opportunity to help lower premiums in communities across the country. But it takes work on the part of the local officials to proactively get into the CRS program and do the activities and provide the information, fill out the paperwork that they are supposed to do to help lower premiums. But we think this is a great opportunity, and we're going to be working with FEMA and with local communities, with local realtor boards and associations across the country to say there's this program out there, and here's a way you can get directly involved to help lower premiums in your community.
One of the things that we've all seen, I think, is comments from Maxine Waters and things that we're seeing online about changes that are being suggested to fix the issues that we've brought up today. And Russell referred to that when he spoke before. But what is the status of those? Can we expect anyone to ride in on a white horse and rescue us? I don't know who might want to address that.
I think that might be me. because these guys, the FEMA folks can't really talk about legislation too much, and that's understandable. So let's think through a little bit about the political dynamics of this program. As I mentioned, there are people who would love to get rid of this program completely. Would love to say, federal government doesn't belong in insurance markets. They need to get out. There are other folks who would love to make the phase outs of the subsidized properties that we were talking about happen right away across the board. And that was something that actually NAR fought against. We made sure there was a longer glide path for these subsidized phase outs. But there are people who say, fine, we'll get the program. We want everybody to pay actuarial right away. There are other folks who would love to see nothing more than to just have the status quo. Right now, in terms of the legislation to delay the increase, right now it passed out of the House. It is now under consideration in the Senate. But as you know, there may be a few other things happening in Congress right now. You have a little thing called, the federal government shutdown. You've got something happening in Syria. So you have other issues that always seem to push the issues that we care about off the plate. But we're working with Landrieu. We have circulated letters to push her to move the delay of the rates. Now, I say delay because that's really all it is. This is not the silver bullet that's going to magically erase the premium increases. I want to make sure everyone understands this is a delay of the program and a delay of the rate increases until such time as the affordability report is completed, done and completed to Congress. So it's a stay of execution, if you will, for some part. But eventually these other rates are going to go in unless and until Congress steps in and says, you know what, we made a mistake on grandfathering, so we're going to reinstate grandfathering, or some other statutory language that would get rid of the rate increases completely.
Tom, did you want to add?
Basically, I kind of reiterate that, because if you look at the big picture, if only 25% are being affected of all the flood policies, and there are 5.5 million flood policies out there, and remember the illustration I showed you where $3,800 for a pre-firm and $8,500 for a post. Well, what's supposed to happen is there's supposed to be a balancing act where the post rates are coming down, so those that are post-firm should be receiving a benefit as the pre-firm increase, which doesn't help anybody that's pre-firm, unfortunately.
Can I just add something to the two types of subsidizing that we talked about, the older homes and the grandfathering. The grandfathering subsidies are cross-fed, which means that it doesn't create a hole in the policy, in the program. If somebody is benefiting from grandfathering, it means that somebody else is paying a little bit more than they should. When it comes to the older homes, there is no cross-subsidizing of that discount. It just is money that annually doesn't go into the program that they feel should. So the reason why they put grandfathering as the second item on the agenda, I believe, was to recognize that it's not losing us money, but it is one of the tenets of the Bigot Waters was that people should pay insurance premiums that reflect the actual exposure of their particular building, over time. So.
Okay, here's another great question. If you are in the flood zone, can you avoid insurance if you elevate the home above the required level?
Generally, no. The requirement for purchase of flood insurance comes based on whether the structure is in the special flood hazard area or not. So as long as you have one of the triggers for the mandatory purchase, a mortgage, home equity loan, etc., then if you are in that special flood hazard area, you will be required to purchase the insurance. However, any of those measures that you're talking about, whether it be elevating the home, and in some cases there can be much simpler, less costly measures that can be done. If the only thing that's below the base flood elevation is your basement, and you either don't have anything in the basement, all you have is your furnace and hot water heater down there, if you move them up to the first floor, find them a closet or some other space, and fill in your basement, that can make a substantial reduction to your premiums. You'll still need to have the insurance as long as you're in the flood zone, but your premiums can be decreased dramatically.
And is the flood insurance premium tax deductible?
I don't believe so.
I don't think so. I mean, if you have a loss and and somehow you're not covered, or then that's you might have a discount, rather a tax deduction there. But as far as the premium itself, I don't believe so.
You talked about pre-firm and post-firm. What are the dates that determine those two categories?
Okay, the date for determining pre or post-firm is going to vary from town to town. It's the date of the first flood insurance rate map for that town. The way to find that the easiest way to find that is FEMA has a product called the Community Status Book. And if you just go online and do a search for FEMA Community Status Book, Massachusetts, you'll see the table, and one of those columns will be labeled date of initial firm. And that's the date for each community that will be the date that tells you whether you're pre-firm or post-firm.
Going on the date theme here, when will all the proposed maps be available?
That's your maps. That's my maps. They're not my maps. I'm not sure I understand the question entirely. There's the maps. They're sort of done in stages. In most places where the maps are being updated, what is out now are what are called the preliminary flood insurance rate maps, which are essentially the draft maps that are out for review, comment, and appeal. Those maps are available online through the FEMA Maps Service Center. Again, if you go to that Maps Service Center and look in the product catalog, there's a tab that's called Preliminary Flood Products or something like that. After those maps have become finalized, then those new maps, which are going to become the effective maps, will be placed online, but that won't be until most likely the first couple of months of 2014 for those counties where the maps are scheduled to be effective in the summer.
Russell.
Yeah, and one thing about these preliminary maps, there's a whole regulatory process at the local level that these maps have to go through to get approved. So they have to be distributed to the community. The community reviews them and comments. They have to be reviewed by engineers and other people knowledgeable about flood risk in the community. And then they actually have to be voted on by the city council or the county, whoever the elected local officials are. So there's a very long and involved regulatory participation process that I've been encouraging our state and local boards and associations get involved in that process. When you see these maps come online for review and comment, because it makes a difference when you have people commenting, reviewing and commenting and providing additional information about whether these maps are correct or not. So that's really an important kind of decision point and I would encourage you, go back to your local boards and associations and tell them, hey, make sure to review this map information and provide input.
Yeah, that's one thing. Don't forget your local communities. What we've seen is they've had this information a while. A lot of them have sophisticated software, so those preliminary maps are actually accessible to the community. They can actually overlay some other type of mapping data. Sometimes they have the ability to take the old map and the new map, and you'll kind of see the shaded areas that are changing. It's almost impossible to get a specific address, but you know what's going to happen. But at least you'll be able to see that. But I would definitely start with your own community facilities. They might have that.
Will it be necessary to have a flood policy in effect to be able to purchase homeowners insurance? John, maybe?
Yeah.
Certainly it depends. Most companies that will write directly up to the coast do not require underlying flood insurance because it is one of the major exclusions from a homeowner's insurance policy. There are companies out there that will write at the coast and also do require that you have an underlying flood insurance policy as one of their underwriting guidelines to offer the property policy to you. In Massachusetts, we can always fall back on the Massachusetts Fair Plan, which would not require underlying flood.
And if the National Flood Insurance Program is not, if it were not made available by the government, do you think that the void would be filled or will be filled in the future by the private sector?
Well, probably because I have the most years in the insurance industry. There was an executive for one of the very largest reinsurance companies in the world had a speech where he said, you know, private industry can handle flood insurance. And if you read the last paragraph of his speech, he said, however, we won't make this available to any property that's at risk.
Annie, if I could just
Yes,
elaborate a bit on that. I'm not sure how I can elaborate on that. That's pretty good. So this idea of private flood insurance, I would love to tell you that there is a robust, thriving market for private flood insurance in this country. You may pay a little more, but you get great service, or you'll make up something. There is no private flood insurance market. And this is coming from the folks that we talk to on a regular basis in Washington, our counterparts in the insurance associations. We've asked them several times over the past year as this issue has grown in importance and visibility. Why is it that none of your companies want to write private flood insurance? Isn't there a market there that that you could take advantage of and make some money on? And they say, yeah, there's a market, but we'd have to charge actuarial rates. Plus, our shareholders want to make a profit. And they have a fiduciary responsibility to their shareholders. Plus, they have additional administrative costs that that they have to maintain. So, the information that they are providing us is it's not worth it to them. They don't think they could sell the product, and they would have to practically double the rates to make any money on it.
Yeah, could I add to that too? The when you go for your insurance professional degrees, etc., the first thing that they tell you is the definition of what's commercially insurable, and one of the factors is that the premium has to be affordable for the particular market. And so what happens in private insurance is that when they develop a premium that would be in the $20,000 range or whatever, they just don't offer it. Okay, or if they tried to, the insurance department, who regulates most of that type insurance, would turn it down. The flood program, by Congress, we have to make flood insurance available to everybody. So what happens is we've got the most experience of anybody. So, we come out with these premiums that I flinch at, but because from a regulatory standpoint, we have to make the product available to everybody, and it is what it is type thing. So private insurance probably, again, would never come out with these high premiums because they just wouldn't offer the product in those situations.
Rich?
Yes, I just came back from a vacation in Canada, literally. I was there, I came back this weekend, and I was up in Calgary where they just had massive floods this summer. I was reading a couple of the local articles. Canada does not have a national flood insurance program, and all of those homes that were flooded were not insured because there was not private insurance available. So right now the Canadian government is trying to figure out how to do disaster assistance to take care of all of that damage. So that's most likely what you would be looking at if the NFIP were to be eliminated.
Okay. Well, we're all realtors in the room, and we're a little concerned, I think I can say collectively, when our clients ask us if they're in the flood zone. What would you suggest that we tell our clients to tell if a property, either the seller who's trying to sell their home or a prospective buyer, if it's in the flood zone?
You're queuing me up here for one of our favorite statements, is that every building is in a flood zone. You could be in a moderate flood zone or you could be in a high hazard flood zone. So we pay out, well, using Rhode Island in 2010, that was a really, primarily inland flooding event. I think, and I was calculated this myself, I think about 30% of the claims dollars we paid out were to properties that were not in what we would call a high hazard flood zone, the zones beginning with the letter A as in alpha or V as in victory. So the biggest thing that you have to kind of acknowledge is that water will go where it wants to go. And that you nor me nor anybody else can, the last thing that you would try to assure somebody is that water, Killington in Vermont is not a member of the flood program. It thought it would never happen up there. They had horrendous flooding from Irene. So the big thing would just be, you are real estate experts, and when it comes to whether somebody is in a high hazard flood zone or just, I would start by making that statement, and then try not to do a flood zone determination because you don't have you don't have professional liability for that. Be concerned if you can learn how to print a fermet. I'll tell you, real estate agents, once they learn how to print a fermet, it takes the monkey off your back because you're not doing a flood hazard determination. You're printing FEMA's map from the source. You give it to them, let them make of it what they will.
Just following up on that, some of the things I highlight to real estate folks is when you're talking to the public or your clients, they should know what flood zone they're in. That's one of the first things we do at public meetings. If they don't, Bob has highlighted the ferments is so important. Another thing that's extremely important to property owners, as John was highlighting, elevation certificates. There's some assignment of policies, but after that assignment of the policy is done, an elevation certificate is going to be needed. And quite often, it helps before because there's no other way for an underwriter to rate the policy. So what I try to promote is, if your client does not have an elevation certificate, you may want to recommend that they talk to their agent and prepare them that they may be asked to secure an elevation certificate. Suggest that they discuss flood insurance with their agent. Their agent is the one that can get the rating, can get the pricing for them. And if they need, talk to their local community officials about mitigation. Quite often, putting in flood vents in a crawl space raises the elevation to the first floor from the bottom of the crawl space. And there are other techniques, as Rich was highlighting, the filling in of the basement. That's a little bit beyond most people's thought patterns. But if you're looking at $8,000 a year or $9,000 a year for flood insurance, just by changing the basement around to a crawl space, you elevate the lowest level, and you could be looking at $400 to $500 a year for flood insurance.
One thing I want to add is when you're looking at providing the information on either the flood zone by printing out a fermet or what the premiums are if there's a current policy. I think you mentioned it. Make sure to look at whether there are preliminary maps out, because the current map may show you not in a flood zone or show you in a moderate flood zone rather than a high hazard flood zone. But if the new maps are changing that flood zone, that could be very critical, and that's important information for both the buyer and the seller to be aware of.
Yeah, one of the other things too, I know there's a bank up in New Hampshire there that I spoke with a few years ago, that the two entities for sure that get official flood zone determinations are lenders and insurance companies. When you ask an insurance company to give you a quote on flood insurance, generally they'll get a flood determination from one of these software outfits, the same ones that the lenders use. But the point would be that one way that you could kind of point that responsibility towards the prospective buyer or seller, just go on to floodsmart.gov. There's a place where you can put the address in. It'll give you an unofficial flood zone determination based on the current map. Like Rich said, if there's future maps pending, check with the community officials for where you're doing business, because they'll be aware of it. But the key thing is that, you know, if it comes out and tells that person that they're in an A zone or a V as in victory zone, and it'll have the disclaimers, but that's the point where, you know, you direct them to their insurance agent to see what their options are. Similarly, another, you know, kind of a lazy way to do it, and John will hate me for this, but I mean, if you go into your insurance agent and give them the address and say you want a quote for a preferred policy, if they give you a quote, you know, $300, $400, then probably the insurance company did a determination on that address based on the current maps, and that's why they're giving you the preferred quote, because if they thought you were in a high hazard flood zone, you wouldn't get the quote. So those are things that, in deflecting the responsibility back to the buyer or the seller, you know, that they can do before they even go to their insurance agent. You know, that'll kind of give them some idea. And if you were to be putting an addition on your house, whoever, you know, you would go to in the community, you know, one of the things, if it's a substantial improvement or if you're building brand new, they have to check the flood maps. So they're a resource. Find out, you know, who does that in your communities, and they're familiar with the maps, and they can get to. Now, they're not going to do a flood zone determination for you for the sake of insurance, because they don't have liability for that either. You know, they'll do the determination, due diligence, when it's their responsibility, when you're coming in to build, you know. So, you know, there's something to be learned from that.
You mentioned the elevation certificates. Are the engineers going to be able to accommodate the new demand for elevation certificates, and how much do they cost?
I can generally address the cost. It varies depending on the specific location of the property and how close it is to a benchmark that a surveyor can use to bring that elevation to the property. I've heard costs as low as a few $100s to over $1,000 or more if it is a more difficult surveying job to do. One thing that we often mention is, particularly in areas where there may be map changes or neighborhoods where a significant number of properties might be affected, if you get together with your neighbors, if several of you need elevation certificates, the surveyor can do a whole number of them in a neighborhood at the same time. That can drastically reduce the unit cost for each individual, because a lot of the cost is just the startup and getting the elevation to the property. In terms of meeting the demand, that's an interesting question. I don't know if any of us here have knowledge on that.
From what I've seen, not all of these policies are coming up at the same time. So they're spread out over a period of months. The surveyors I've talked to are all out soliciting. And I know a lot of the agents, the insurance agents and the brokers are working with the surveyors. Now, I've also talked to some surveyors that are not in coastal regions, and they are opening offices in the coastal regions because they recognize this as being a 1 to 2 year increase.
And that would be a good advice you could give to your client, is that there's no doubt that the cost, as Rich said, you know, how familiar that surveyor is with the area. So, you know, a lot of people are so trusting, they'll get one quote and that's, you know, that's it, and they'll get a very large bill. We had, just to be specific, in Connecticut, we had a situation where they paid, down in Fairfield County, but they paid over $2,000 for an elevation certificate. And when I was talking with the property owner, she wanted to use that to do an appeal. And so, you know, they did the elevation certificate, but they didn't give her any advice as to whether the data on that might help her to appeal, you know. So that kind of got me, that they paid that much without getting anything more than the elevation certificate. But I mentioned to her, she had a sense of urgency because the lender was going to force place an expensive policy. So I said, well, go back to that land surveyor, and if they are registered with FEMA and can do an electronic filing of your appeal, it'll save you all sorts of time, you know. And so she came back, and I said, well, did you take advantage of that? She said, yes, they do that. She said, but they said that would be another $1,000. So the big thing is that people need to talk to the surveyors. They need to be specific about why they want the elevation certificate. They need to be specific about when they need it by. They need to ask whether that, you know, they've done other elevation certificates. Are they familiar with the area? Do they know the appeal process? Do they feel comfortable with that? Would they be willing to come to the house and, you know, for a flat fee, just to give their opinion of whether it's worthwhile? Because your baby boomers that paid their mortgages off, that don't have insurance policies. I know one person that's what they were going to give them for Christmas, you know, elevation certificates. So that going forward, when they did decide to sell the house, or if they did refinance, they would already have an elevation certificate to know what kind of a challenge they were going to be facing.
Russell?
Yeah, one thing, and you mentioned the appeals process. I mean, that's something that we've urged people to take advantage of as well, is you can appeal your flood zone designation, your determination as to whether you're not in the flood zone. You can appeal that, and FEMA has a process by which you can go through to make your appeal and get your information to them, and they can determine whether or not the map was accurate. Now, there is a provision in bigger waters that says that if you win your appeal, FEMA will reimburse you for the costs of your appeal. Now, unfortunately, those regulations have not been written yet, and we are urging FEMA to move forward with developing those regulations, because more and more people are obviously going to want to take advantage of the appeals process, and it's you know, it's a great opportunity to recoup those losses. But that's only if you appeal the map and you were indeed found to be out of the floodplain when you were put in the floodplain. You basically proved to FEMA that the map was inaccurate. If FEMA is correct, then obviously you don't get reimbursed for those expenses.
Rich?
I just want to clarify one thing. There's actually two separate processes that people are often getting confused about. One is the formal public appeal period that's underway now for most of those maps. That's a 90-day period where if a community or individuals want to appeal the map, they can provide scientific or technical data to challenge the maps before they become effective. Even after the maps become effective, there is always in place a process called a letter of map amendment or a letter of map revision. And under that process, you can provide specific information about your property to challenge the determination that you're in that high hazard flood zone. That process is always available to you. It's available to you when the maps become effective. It's available, 5 years down the road if you get better data down at that point. So those are two separate processes, and a lot of people think once this appeal period is closed, that's it, they're stuck. That's not the case. You can always go through that letter of map amendment process.
While we're on the same subject matter, and I'd be afraid somebody won't ask this question because myself and Tom run into it all the time. When the lenders before the closing, when they get their flood zone determination, usually the company that they contract with to do the determination, they usually have a provision in there that says if you make a mistake and we get fined by the FDIC, you're going to reimburse us for the fine. So what I see a lot is that the lenders get what's called a parcel determination. Now, they don't realize it, but they, you know, it's the way that the flood zone determination company protects themselves. So if any portion of the parcel is in the high hazard flood zone, the determination form they'll get from the lender will say, you know, this parcel's in the high hazard flood zone, and the lender will then send that along and ask for the insurance. But if the property owner, you know, has talked with community officials and acknowledges, yeah, that line comes across my parcel, but it doesn't touch my building, the lender laws relate to whether any portion of the building is in the high hazard flood zone. You can do an informal appeal. Just get that copy of the determination from the bank, the company that did it, their 1-800 numbers on the back. Call them, tell them you don't think the line touches the house. They'll ask you for a copy of a deed map or something that shows the footprint of the building. Usually within 48 hours, they'll send a new determination to the lender that'll say some portion of the parcel is in the zone, but the building isn't, and then they're happy because that's one of the pieces of the paper that the lenders can accept. The other piece of paper they can accept is what Rich referred to, which is something directly from FEMA, letter of map amendment, and you can do a similar formal appeal if you think that line doesn't touch your house. And basically, it might not even need an elevation certificate, but you know, you can go through FEMA and fill out the same app. The one thing I always tell people that when you go to the Map Service Center website page, so if you just Google FEMA Map Service Center, scroll all the way down the bottom, there's a toll-free number. They have 14 map specialists who are great. They will walk people right through the process. They'll send them the application. If they get to question 4 and they're not sure what it means, you can call them right back up again. They'll also give them some advice as to what kind of an appeal you think you have, and so that you don't do the wrong paperwork and then have it go nowhere. So I just wanted to pass that along.
I've been reminded that we've run out of time, and there are dozens more fabulous questions here, and I'm sorry we couldn't get to all of them today. We do have another program happening in this room right after this one. So I want to thank the panelists today for sharing their information with us.